Hi everyone, this is Knowledge Topper, and in this video we will discuss about another most important ratio, and that is debt ratio. We are basically covering the series of financial ratios. So this is one of the videos of our financial ratio series. We will understand this with the help of an example as always we do. So more importantly, your concept should be clear. You can watch all of the financial ratios videos by clicking the link in the description of this video. But before moving towards the main, if you didn't subscribe to our channel Knowledge Topper yet, please do subscribe to our channel Knowledge Topper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So first of all, we will look at what debt ratio is in general. Then we will further discuss more about debt ratio in detail, and at the end of this video we will solve an example as well. So more importantly, your concept should be clear. So as written on your screen, debt ratio is a solvency ratio that measures a firm's total liabilities as a percentage of its total assets. In a sense, the debt ratio shows a company's ability to pay off its liabilities with its assets. Okay, in simpler words, you can say that debt ratio shows how many assets the company must sell in order to pay off all of its liabilities. Basically, this ratio measures the financial leverage of a company. Companies with higher levels of liabilities compared with assets are considered highly leveraged, and they are basically more risky for lenders. So this ratio helps investors and creditors analyze the overall debt burden on the company, as well as you can say that the firm's ability to pay off the debt in future, or most importantly in uncertain economic times. Okay, if we talk about the formula of debt ratio, the debt ratio is basically calculated by dividing total liabilities by total assets, as you can see here. So both of these numbers can easily be found as well on the balance sheet, and there's one important thing to remember. You always make sure that you use the total liabilities and the total assets in your calculation, because the debt ratio shows the overall debt burden of the company, not just the current debt. Okay, so now quickly jump to our example. So here's an example for you guys. Knowledge Topper's guitar shop is thinking about building an addition onto the back of its existing building for more storage. Knowledge Topper consults with his banker about applying for a new loan. The bank asks for Knowledge Topper's balance sheet to examine his overall debt levels. The banker discovers that Knowledge Topper has total assets of $1 lakh and total liabilities of $25,000. Knowledge Topper's debt ratio would be calculated like this. So as you can see, we have all the information given in our question. We have total assets of $1 lakh, and we also have $25,000 of our total liabilities. So we just simply put these values in our formula and calculate the answer. So as you can see that we have $25,000 of total liabilities, and we have $1 lakh of total assets. So we just simply calculate this $25,000 by $1 lakh, so we will end up with 0.25. So here another more important thing related to the answer, the debt ratio is shown in decimal format because it calculates total liabilities as a percentage of total assets. Okay, as with many solvency ratios, a lower ratio is more favorable than a higher ratio. Okay, so in our case, as you can see, Knowledge Topper only has a debt ratio of 0.25. So you can say that the Knowledge Topper has 4 times as many assets as their liabilities. So this is a relatively low ratio, and it implies that Knowledge Topper will be able to pay back his loan easily. So Knowledge Topper shouldn't have a problem getting approved for this loan. Okay, normally in terms of debt ratio, we will consider a lower debt ratio. It usually implies a more stable business with the potential of longevity, you can say that, because a company with lower ratio also has lower overall debt. So each industry has its own benchmarks for that, but we can say that 0.5 is a reasonable ratio. Okay, because generally a debt ratio of 0.5 is often considered to be less risky. Like basically this means that the company has twice as many assets as its liabilities, or you can say that this company or any company has liability, like any company's liabilities are only 50% of its total assets. So like essentially only its creditors own half of the company's assets and the shareholders own the remainder of the assets. So you can say in that way as well. And let's suppose the answer comes out to be 1, so a ratio of 1 means that total liabilities equals to total assets. So in this scenario, you can say that the company would have to sell off all of its assets in order to pay off its liabilities. Obviously, this is a highly leveraged firm. Once its assets are sold off, the business no longer can operate. Okay, so while concluding, I will just say that the debt ratio is a fundamental solvency ratio, because creditors are always concerned about being repaid, and this is the most important ratio in terms of their concerns. So basically when companies borrow more money, their ratio increases, creditors will no longer loan them money. Okay, and basically companies with higher debt ratios are better off looking to equity financing to grow their operations. So this is basically the ratio that is more watched by creditors. So this is the video for all of you guys. Hope you clearly understand about debt ratio. If you like this video, thumbs up. Do subscribe to our channel Knowledge Shopper, as well as like our Facebook page, and do join our Facebook group as well, where you find a lot of good material related to these topics as well as from other courses as well. So this is the video for all of you guys. Thank you so much everyone. It's time to say bye bye.